They can only get a 2% bonds, and now they're living on what? $20,000 a year. That's pain, right? And so, and remember that what? Bonds are called when what? Interest rates go down.
Mm-hmm.
Same as when do people refinance their homes? When interest rates go down. Okay? That's all it is refinancing the debt, which we talked about. Okay? Which is why bond holders look for call protection to protect against this. Remember the two features of bonds that you can get to protect you against these two risks. You have call protection, which can protect you against the bonds being called, and you also have the put feature, which would protect you against interest rate risk if interest rates were to rise.
Yep.
Okay? All right. And then we have inflation risk. Now, inflation risk, also known as purchasing power risk, is the risk that your investment that's producing income at a steady rate is going to have less and less purchasing power because of inflation. And once again, there's three things that are subject to inflation risk. The three things that have a fixed payout: bonds, preferred stock, and fixed annuities. All three of those have a set fixed payout. If you're getting $1,000 a month, you're going to get $1,000 a month until whenever, right? And and what that means is that you are subject to inflation. And then finally, we have currency risk. Now, currency risk or exchange rate risk is the risk that you cannot exchange your foreign investment and get all of your money back because of the changes in that exchange rate. So the acronym to help you remember here is PRIME. So P for purchasing power risk or inflation, R for reinvestment risk or call risk, I for interest rate risk, M for market risk, and E for exchange rate or currency risk. So those are your 5 systemic or systematic risks. Okay? All right. Then we have our non-systemic risk. Now, the big difference between systemic or systematic and non-systematic risk is that with non-systematic risk, you can diversify away this risk because it affects a single company or a single group of companies. It doesn't affect the entire marketplace. So by properly diversifying your portfolio, you can diversify away non-systematic risk. So let's go through these risks. First off, you have business risk. Now, business risk is the risk that a particular company does poorly because of poor management decisions, right? This is Blockbuster not following through on their offer, or because Netflix contacted Blockbuster and offered to sell themselves to Blockbuster. Blockbuster said no. That's a poor management decision. Did you know that Kodak invented digital cameras?
Didn't they keep it hidden?
What?
Didn't they keep it hidden?
They didn't really keep it hidden. They just weren't able to capitalize on the digital cameras. They just, and this is typical of big companies. It's called the inventor's dilemma or something like that. That's not the right term, but it's the dilemma of a big corporation that invents something, but big corporations are not risk takers, right? And so they're not going to do anything risky. So Kodak didn't take any risks, but that was it in the long run, a poor business decision. Now, strangely, because Kodak kind of almost went out of business. They sold off branches of their business, sold off their logo, and sold off this, and were barely left in business. But they're experiencing a resurgence now, strangely, because a lot more people are starting to shoot with film because of the nostalgia of film, right? So they're back in their still original core business. But that's an example of poor business decisions, right? And then we have default or credit risk. Now, default or credit risk is with bonds. So business risk is with stocks. Default or credit risk is with bonds. And this is the risk that the bond issuer doesn't make their bond payment. They default on their debt, right? Now, obviously, that would be a problem if you're the bondholder. That means the person you lent the money to is now not going to pay you back, right?
Mm-hmm.
So that's called default risk or credit risk. And then we have financial risk. Now, financial risk is what happens to the stockholders of a company that goes through credit or default risk. Financial risk is back to the stockholders, but if a company fails to pay their debt, then their stockholders are going to have a problem. Make sense?
Mm-hmm. Mm-hmm.
Now, obviously, their bondholders are going to have a problem as well, but that'll be credit or default risk. But for the stockholders, we call that financial risk because they didn't pay their debts. Then we have prepayment risk. Now, prepayment risk is similar to call risk, but it only affects Ginnie Maes or the collateralized mortgage obligations. Because, as we already know, if interest rates go down, what do people do? They refinance their mortgages. Well, what is Ginnie Maes? Their mortgages. And so what happens is that with those Ginnie Maes is that the mortgages are refinanced, which means they get, just like with a call, well, they're going to get their principal back, but they're not going to get all that future interest that they were expecting. Make sense?
Yeah.
All right. And then we have liquidity risk, which is the risk that you cannot go out in the marketplace and quickly sell your investment to turn it back into cash. Direct participation programs, those limited partnerships, are very, very hard to sell. Getting out of one of those would be like getting out of a timeshare, right? There's literally no secondary market for that kind of thing. So it's really hard to get out of those things. They're not very liquid. There are also certain stocks where they are what they call thinly traded. And when they're thinly traded, you have to sometimes sell at a much lower price in order to get out of them.